The top business stories live from the Sky News City studio. UK-based chip designer Arm Holdings secures a $54 billion valuation ahead of its blockbuster stock market flotation later today. A setback for John Lewis as it warns that its turnaround will take 2 years longer than expected. Plus, will the European Central Bank vote for its 10th consecutive interest rate rise this lunchtime? Good morning, this is Business Live with me, Ian King. All eyes will be on Wall Street this afternoon as the UK-based chip designer Arm Holdings returns to the stock market in the biggest IPO of the year so far. Shares in the firm are scheduled to start trading on the Nasdaq in New York later today. The company secured a $54.5 billion valuation ahead of its flotation. Well, a little earlier, the founder of Arm, Herman Hauser, told our colleagues at CNBC that he's still holding out hope for a secondary listing on the London stock market.
Was always dual listed in London and in New York before it was taken over by SoftBank. So my hope was that we would have a dual listing again. And indeed, I wouldn't rule that out eventually, that there will be a secondary listing in London as well, given that we've got lots of support in the London market for the ARM chips. And we, of course, did have great support in the London market before SoftBank took Arm over.
Well, joining me now, CNBC's senior technology reporter Arjun Kapar. Arjun, good to see you this morning. Pricing was achieved at $51 a share. I mean, there have been speculation they might even go above that.
Yeah, there was a lot of reports about high demand for this listing, that this listing was multiple times oversubscribed and potentially they could price this above that range of $47 to $51. They ended up on the top of the range, which is a big win for SoftBank. Look, there's a lot riding on this IPO for SoftBank. This is a company they acquired in 2016. It's been key to the company's vision, and the SoftBank founder Masayoshi Son has spoken about how critical Arm could be to the future in technologies like artificial intelligence. And so SoftBank needs this to do very well, and it needs it to come off on IPO day very well. One, from a reputational point of view, SoftBank has picked up a reputation of perhaps making investments that haven't quite come off very well. And so it needs to show that, one, it can return that money to shareholders, but also raise money to shore up its balance sheet, to continue investing and show that its investment in Arm is a good one, not just on IPO day, but certainly over the longer term as well.
On that basis, would you expect to see the shares get off to a first day premium?
They should do. This, as we've mentioned, is massively oversubscribed. And interestingly, SoftBank has only floated about 10% of the company's shares. So that gives you a sense that there's also some scarcity of shares. And we heard this week TSMC, a Taiwanese chip manufacturer, the largest in the world, said it'll buy up to $100 million worth of shares as well. And there's also interest from companies like Google and Nvidia as well to buy shares in this company. So a lot of interest, not just from these companies that are also customers of Arm, but also from big institutions as well. And certainly there'll be a piece of the action for retail investors hoping to get involved in this. You viewers may have heard a lot about Nvidia, another chip company that's really seen a more than 200% rally in its shares this year. And so there's many looking to Arm to wonder whether this could be the next big bet for investors. It's a very different proposition to Nvidia, mind you, but certainly a lot of investors looking at where else they can get in some of these semiconductor firms, which are incredibly critical to a lot of the technology we use today.
Yeah, now at this price, Arm is being valued at 100 times earnings. How does SoftBank justify that valuation?
That's huge. That is a massive valuation. It's very tricky. SoftBank, of course, bought this for around $32 billion in 2016. They need to show the return. And so it's not quite the double the return, but it's certainly a return. This valuation is very tricky because Arm right now is seeing growth stagnate. In its latest fiscal year, its revenues fell 1%, and that's because a lot of its revenue still comes from licensing and royalties around consumer electronics such as smartphones. And that's a market that's seen stagnating growth. It's a market that doesn't look like it's going to recover, at least this year as well. And so Arm's going to need to convince investors over the next year or so that it has future growth. And some of that could come from the chips that go into data centers, where a lot of these AI models are being trained. Some of that may also come from areas like the automotive industry. There's a lot more chips going into cars. And that's an area Arm's spoken about as well. So the key for it to sustain this valuation and for its shares to continue any kind of run over the next year is for Arm to convince investors that it has a future growth plan beyond just consumer electronics.
Yeah, I mean, not only are revenue stagnating, it's also facing increased competition from open architecture software.
Yeah, fascinating. I've been writing about that this morning, Ian. RISC-V, RISC-V, that's a new open source architecture. Now, the way, of course, Arm makes money is by charging licensing fees for its architecture, which is effectively the blueprint that underpins chips that go into 99% of the world's smartphones. But RISC-V is an alternative architecture. It's open source, therefore it's free. And it's got the backing of a lot of Arm's own customers. The likes of Qualcomm, the likes of Google and Nvidia are looking into this technology. Now, Arm in its IPO prospectus actually warned about the risks from RISC-V, saying that if this gains a lot of traction, if there are sort of advancements in the technology, this could certainly pose a competitive threat at this point. Now, analysts I've spoken to this week have said, in terms of from the technology perspective, RISC-V isn't quite up there with Arm yet. Arm is ubiquitous. It has an ecosystem of developers. If you're running software on one Arm chip, it's likely to work across other Arm-based chips. That is not something that RISC-V has at this point. But given the interest now from some of the biggest technology companies in the world, I think Arm will be looking at RISC-V certainly as a potential competitive threat over the coming years. And the big question is also in China. If companies in China begin developing RISC-V-based chips, again, that may give it a lot more impetus in terms of growth and in terms of becoming a competitive ecosystem to Arm.
All right, Arjun, got to leave it there. Good to see you this morning. Thank you. Now, the John Lewis Partnership warned this morning that its turnaround will take 2 years longer to accomplish than expected. The owner of Britain's biggest software department store chain and the Waitrose supermarket chain said a combination of inflationary pressures and greater than expected investment requirements meant the plan would now come to fruition in 2027-28 rather than 2025-26. Well, the partnership was reporting a pre-tax loss of £59 million for the 26 weeks to 29th of July. That was a 41% improvement on the same period a year earlier. Total sales at the partnership rose by 2% to £5.8 billion. And Dame Sharon White, the partnership's chair, will be on our afternoon programme at 4:30. Do tune in for that. Shares of THG fell by 16% today after the online retailer reported that operating losses for the 6 months to the end of June widened to £99.5 million from £89.2 million in the same period last year. But the company, previously known as the Hut Group, insisted this was due to a one-off charge following a decision to dispose of non-core assets and loss-making discontinued categories. It said sales trends were improving, and especially in its beauty division, following an end of a period of significant destocking across the industry. And the spread betting and trading platform IG Group has reported a rise in quarterly revenues despite a small drop in the number of its active clients. IG, whose chief executive June Felix stepped down recently on health grounds, reported revenues of £242.9 million for the 3 months to the end of August. That was up £1.1 million on the same period last year. This reflected a rise in interest income and strong sales growth in the United States and came despite a 4% fall in the number of active clients to 267,000. The shares currently ahead by 1%. Now, after 9 consecutive interest rate rises, the European Central Bank is widely expected to raise interest rates again in the Eurozone today. The ECB is expected to take its main policy rate from 3.75% to 4%, which would be its highest since the euro was created in 1999. Well, there had been speculation until relatively recently that the ECB would put rate hikes on pause this month, but the August inflation figure came in at 5.3%, more than twice the ECB's target rate of 2%. Well, joining me now is Safia Salim, the head of European rates research at the Bank of America. Great to see you this morning. Do you expect the ECB to go again today?
Yes, we do. I think that a lot of analysts were still very unsure about it. Just a few days ago, the market was still pricing in only 50% chance of that happening. But we do think that the inflation backdrop in general will motivate the hawks to deliver this 10th extra rate hike.
So that was what changed then? It was the August inflation number that made
that absolutely. Plus, also we've seen that inflation expectations have edged higher. We're also noting that in the last few days, we've learned that potentially the ECB will be upping its forecast for inflation next year in 2024 to above 3%. So not only raising the 2023 inflation projection on the back of the upside surprises we've seen in inflation, but potentially even extended that increase into 2024, giving therefore the Hawks a lot of ammunition to push for that extra hike.
Yeah, I mean, it's really interesting. The European Commission changed its forecast. They cut their growth forecast for the Eurozone for this year and next. And also inflation. They see inflation remaining well above the target rate for the whole of next year.
No, absolutely. I think that is really the challenge here that made this decision so uncertain, and that will probably steer a big debate at the ECB today. Growth projections are likely to be revised lower, both for this year, next year, even potentially 2025. So are we going to see a central bank that is now moving to being a bit more forward-looking, acknowledging those downside surprises in growth and therefore the potential downward pressure that it will ultimately put on inflation in the long run? Or will they stay focused on short-term inflation as they have been over the last 9 meetings? We think the Hawks will still be able to maintain this focus on inflation.
Given that deteriorating outlook for growth, though, and the fact that Germany's in recession, is there a case for the ECB hitting the pause button today?
Yes, certainly that will be the main issue debated. But I think that if you think about this central bank, it is seen at the moment as being the one that is most committed to the 2% inflation target. This is what our FX and rate sentiment survey that we ran last week was showing. Investors see it as more committed to the 2% target than the Fed or the Bank of England. So in that context, the ECB may want to prove to us that they are indeed a lot more focused on that, and will probably accept that the risk to growth are going to be there, but that their mandate needs to be focused on inflation at the moment.
OK, got to leave it there. Sophia, great to see you today. Thank you.
Thank you.
Well, Wall Street enjoyed solid gains last night after the August inflation figures raised hopes that the Federal Reserve will leave interest rates unchanged this month. And stocks in the Asia-Pacific region enjoyed gains overnight on the back of that news. All the main indices in the region finished in positive territory. Look at the Nikkei there in the top corner, up nearly 1.5%. Well, in Europe this morning, stocks have been pretty mixed. Here are the continental European indices. Only the DAX in Germany in negative territory right now. Talking points in continental Europe this morning include the Danish shipping giant Maersk. It's up by 2% in Copenhagen after it set up a new business to produce green methanol. Well, here in London, the FTSE 100 is also firmly in positive territory, 1% to the good, in fact, right now, in a broad-based rally led by some of the mining heavyweights. In percentage terms, another leading gainer today is the life company Phoenix. It's up nearly, well, there you go, it's up by more than 2% now. That's on news that its forthcoming trading update is going to contain numbers that are ahead of expectations. Several blue chips are automatically trading to the downside today. That is because they've gone ex-dividend. In other words, they're trading for the first time without the rights to the latest payout. You can see them all on the screen there. Intertek, Unite Group, the student housing specialist, and Melrose, the engineering giant. All of those, as I say, gone ex-div today. Outside the FTSE 100, the music catalogues investor Hypnosis Songs Fund is up by some 1%. That's after it sold some song catalogues to its investment advisor. While the Trainline, the shares there steaming up some 13% on a trading update. On the foreign exchange markets, well, all eyes are on the euro ahead of that interest rate decision today from the ECB. Euro's currently slightly trading ahead against the US dollar. It's also up by 1/6 against the pound. Pound off against both the euro and the dollar this morning. Meanwhile, the oil price remains close to a 10-month high. Barrel of Brent crude is currently changing hands at $92.76 a barrel. That is up just shy of 1%. So joining me now is Patrick Farrell. He's Chief Investment Officer at Charles Stanley. Patrick, great to see you this morning. Let's start with the US inflation data last night. The number came in ahead of expectations. On that basis, why do people think that the Fed may hit the pause button this month?
Well, I think there was a little bit of relief associated with the number yesterday. And on the back of that, the bonds actually had a little bit of a rally in terms of yields, and the equity markets seemed to be more relaxed. Does it mean that the Fed are done? I don't necessarily think that that's the case. Yeah, they have made a commitment to make sure that inflation is on a convincing path back to 2%. And with some of the energy impacts coming through, particularly on gasoline prices, so gasoline prices were up 10.6% for the month. And I think that there is, with the oil prices, you rightly pointed out, with that sort of moving in that sort of direction, with a very much a supply-led constraint coming through, I think we're in a sort of situation where those energy price spikes are going to continue to hamper the path for inflation to get back down to that 2%, at least in the next sort of 6 months, Ian.
Now, the big event on markets today, of course, is the IPO of ARM Holdings. The fact that they've gone for a US listing rather than a UK one has prompted a lot of soul searching over here. What do you think can be done to make the London market more attractive to new issues?
Look, it is a difficult one because when companies are listing, they're trying to follow the flow of money. And the US is a big market and it does attract the actual investor flows. So from a UK perspective, it's difficult because the degree of scale, as the momentum of that scale starts to deteriorate, then it becomes more and more of a problem. So it does need a circuit breaker. It needs some sort of intervention, either from a government perspective or from a sort of market perspective. But I think we need to offer some incentive for UK investors in particular to basically look at how they can invest in companies and either get a tax benefit or something along those lines in order to attract companies to actually list in the UK.
Well, we can but hope, can't we, Patrick? Now, among the updates that we've had today, it's not a listed company, but nonetheless of enormous interest to everyone in the retail sector, John Lewis Partnership. What did you make of the numbers they put out today?
Well, as we know, it's been very difficult for the retail sector in general, but particularly if you're going through a restructuring plan at the same time, the cost of the inflation piece and just the domestic economy sort of starting to really slow down quite aggressively, I think it makes it very, very difficult for a company like John Lewis to basically, in the middle of a restructuring plan, continue on with that plan. So, look, it is difficult time for retailers. I think it's a situation where I don't think the short term is going to look any better. So for them, and I think that those struggles will continue, and they'll be faced with a situation where they probably have to discount more. Margins will come under pressure, and hence any sort of restructuring plan is still going to have that delay aspect to it.
All right, Patrick, we've got to leave it there. Great to see you as ever this morning. Thanks very much indeed.
Thanks very much, Ian.
Still to come here on Business Live. Rise in patients going private as hospital waiting lists hit a record high. We'll be speaking next to the Chief Executive of Spire Healthcare. Don't go away.
I'm Greg Milam and I'm Sky's Chief North of England correspondent. We aim to be the best and most trusted place for news.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, the number of people in England waiting to start routine hospital treatment has hit an all-time high, according to new figures published this morning. Well, those come as a survey published this week suggests that 1 in 10 adults in the UK have turned to private healthcare in the last year. And that strength of demand was highlighted today when Spire Healthcare, the UK's second largest private healthcare provider, reported an adjusted operating profit of £67.8 million for the 6 months to the end of June. That was up 24.2% on the same period last year. Well, joining me now is Justin Ash. He's Chief Executive of Spire Healthcare. Justin, very good to see you again this morning. Thanks for joining me. Where are you seeing growth strongest right now?
So there's obviously a lot of demand for healthcare. We're very pleased with these results, with revenue up 13%. Private care, both people paying for themselves and insurance. There's a clear trend of people choosing to either have their diagnosis privately, to go to a private GP with our private GPs, to have their treatment privately. But also more people are starting to take out insurance, so personal insurance products are up. And employers are beginning to see private healthcare as a way not just for top executives, but for the broader workforce, as a way to keep people fit and healthy. So that's a clear underlying trend in the market and in our results. And we've been pleased that so many people have chosen Spire Healthcare.
There are a lot of suggestions that people are increasingly eating into their savings or borrowing to access private healthcare. Are you seeing different socio-economic groups accessing your services than you were in the past?
So it's definitely the case that private healthcare is seen as an option by many more people across socio-economic groups. Now, we wouldn't want anybody going into unaffordable debt for private healthcare. We offer affordable loans, but actually very few people take those up. If you look at the economic groups, actually there is quite a lot of growth, first of all, in younger people who didn't used to use private healthcare, but also in people whose family income is 50,000 or below. And I think it's worth noting, by the way, that whilst a hip replacement might cost £10,000, which is a lot of money for many people, to have a consultation with a consultant to be assured about whether or not there is something that you should follow up might cost £200. And it's not nothing, but that's affordable for a lot of the population who are choosing to do that because they are finding it difficult to see their GP. And a private GP appointment with us is £80 to £90. Again, it's not nothing, but our private GP is up 41%. So clearly it's affordable for many people.
Now, as we've discussed many times in the past, you also support the NHS. Where are you seeing most activity on that front?
So it's important for us to support the NHS. There are record waiting lists, and it really is all hands on deck to bring down these waiting lists. We and the independent sector play an important role there. In fact, our income from NHS and our activity there is up 17%. Why is that? It's because people can choose on the NHS as well. And there has been a government task force which has recommended this, which we welcome. So if you are stuck on a waiting list and you go to your GP, you have a right to have that GP look online. It's a simple system to choose which provider has got the shortest waiting list. And we work with GPs to explain to them how that system works. And nearly all of that 17% growth has come from people who are on waiting lists, being helped to choose to come to Spire. And we also do some work with NHS trusts. So there are some people who've been waiting a very long time, more than a year, and we'll work with NHS trusts collaboratively to help take some of those people who've been waiting so long and treat them in the hospital. So yes, we're supporting people who pay for themselves. Yes, we're working closely with insurers, but we're also working with the NHS because this is, you could describe it as a crisis at 7.6 million people, and we all have a part to play.
Justin, you referenced your GP services just now. I know this is one of your big investment priorities. How big a part of the business can it become?
Well, it looks like it has enormous potential. So 41% growth like for like. We've just opened now 5 new GP practices in London, and they get busy straight away. I think generally primary care is an area we will be expanding because there is so much need here. So I think it's going to play an important part, as will other services in the community. We've launched a long-term diabetes support service because it's just as important to get diagnosed as to get treated. Clearly that's important if you've got a sore knee, but let's remember, the quicker you get diagnosed with cancer, the more important it is. And there are many ways to get diagnosed, and anybody who's got a condition they're worried about should get seen. People are coming to private GPs because you can literally book overnight, you can come in and see someone the next day, and you have a face-to-face appointment. And I do think the age of technology is exciting, and booking online is technological, but we all like to have a face-to-face meeting with a medical professional. And that's really what's driving our growth. High quality, safe, with a medical professional face-to-face.
Justin, got to leave it there. Good to see you today. Thank you. That's it from me. I'm back at 4:30, and as I say, I'll be joined by Dame Sharon White and John Lewis. Do you know you can join me for that? See you later.